Hey guys, in this video, what I wanted to do was for you guys to visualize what market returns are, beta and alpha. I made this using Claude. I think it looks really good, and I'll have this available in the video description for anybody to use. I'll have the file in there. It's just a web file. It's pretty small, but what this demonstrates is a relationship between three variables. This is your beta, your market sensitivity or market risk. This is your total risk, and this is your expected value. So what is this shows that there are returns that are expected within the market. So everything on this plane is what you could expect from the market. Nothing in this plane is beating the market risk adjusted. Nothing in this plane is underperforming the market risk adjusted. And that is what I really like about this presentation. It kind of shows you where everything is. And this line right here, this is the efficiency frontier. This is basically you're maximizing your return for the amount of risk you take on. And we have a few different and very important assets here. The most important one and kind of our baseline is always going to be the T-bills. T-bills are what the US government will pay you for lending money to the US government. T-bills have zero risk, they have zero beta, and they're assumed to be risk-free. If you have a T-bill, it can never go bad. The US government can never default. Therefore, T-bills are assumed always to have zero risk, but they also have zero alpha, but they have a return to them because it's a zero risk. This is the benchmark that all other assets have to perform against. Because if you can find something that is, say, you know, more risky than zero risk, it has to do more than this 4%. Because otherwise, why would you, if it was something, say, like you took on 10% risk, but it was only giving you 5%, it's simply not worth you buying it. T-bills are better, and everything is compared to T-bills. So further up this efficiency frontier, you have the market. The market is assumed to have a beta of 1. A beta is just you take on the market risk. If the market is assumed to be, say, 10% in a year, and it has 1 beta of volatility, 1 beta of risk, this would mean that your beta is 1. It will never be more or less than 1 because your benchmark is what you compare your returns to. The risk-free rate factors into your alpha, but the benchmark is what you have to beat. Typically, whenever you're doing something like this, your asset is not risk-free and you're trying to beat T-bills. But the one that you have to beat when you're doing something other than, say, T-bills or the market is the market itself. If you can't generate a return more than the market, simply put, you're taking on too much risk. And up here we have a leveraged index. Now, a leveraged index has no alpha. As you could see right there, it says zero alpha. But what you also see is the return is double that of the market. This is assuming it's a 2x leveraged index. Plenty of those around. You can find ones on QQQ. You can find one on VU, Vanguard, S&P 500, the State Street S&P 500, the SPY fund. It's one of the more popular ones. This isn't actually being the market. Even though it has a higher return, you're also taking on double the risk. And this is the way that you guys have to look at this. If you take on double the risk, it's not enough simply to be compensated double. Your return would have to be greater than double the risk for you to produce an alpha. This doesn't actually produce an alpha, even though it looks like it's beating the market, but because you have double the risk, you also have double the losses. So in the end, you actually aren't beating the market with this. Over the long term, leverage indexes can underperform the overall market in terms of total returns as well, because those losses for the market, it could be, say, a 30% drop, which is what it was around 2008. It was around a 30%, even greater. Maybe it was like a 40%. With the 2x, that would be a 60 to 80% loss, which makes it very difficult to recover from, which is why, simply put, just having a greater amount of leverage isn't the same as beating the market. And everything within this plane is expected for the level of risk you take on. So for example, you take on, let's say, 0.63, about 60% of the market risk, you have about 60% of the returns. So as you can see here, you have about 0.67. This is about 8% return. You take on about 70, 80% of the market's risk, you get around that return. And the higher up you go, the more return, but of course, the more risk. And you want to stay on the efficient frontier. This basically means that the risk allocated to your return is optimal. But now we get to talk about the fun part, returns outside the market. This is what everybody wants. This is where your alpha is. But this is also where your underperformers are as well. So if we were to click over here, we can see now that we have 4 extra data points. The two red data points are underperforming, and the 2 green data points are overperforming. And we're going to talk about the red ones first. So a high fee fund, for example, this is like a mutual fund. Plenty of those around where they don't perform very well when compared to like an ETF or a passive fund. They tend to underperform. And the reason that they underperform is, for example, you would take on 1.1 risk and you would expect roughly about 10.6% return for taking on about 110% of the risk of the SPY. SPY is 100% risk of the market, but because you have extra fees there and these are typically manually managed funds, they tend to underperform. What ends up happening is you're going to lose about 2.86% alpha, meaning you're underperforming. And this fund is not necessarily negative. This doesn't mean you're losing money on this investment, but what it does mean is that if you were to buy the SPY instead, you actually get a higher return for the amount of risk you're taking on. And the other one we have over here is the performance chaser. So the performance chaser is taking on 1.3 times the risk. So basically they're taking on 130% the risk of the market, 100% assuming 1 beta, that's exact risk of the market. But for taking on 130% risk, you're only getting 9%, whereas the market for taking on that kind of risk would have given you about almost 12%. And that gap, that 2.8% negative, is the amount of alpha that you lost. So you actually underperform for the amount of risk that you're taking on. Now for the flip side, where everybody wants to be, we have 2 examples here. And these, I think, are very good examples. So a skilled manager, this is, say, like your hedge fund, your successful financial institution, your quant firm. These are the guys that produce alpha. So for example, you take on 1 beta exactly, you take on exactly market risk, but instead of 10%, you get 14%. So you have a 4% alpha. You're beating the market by 4%. This is a healthy alpha, and a lot of financial institutions, they target close to 1 beta or typically sub 1 beta returns. They want very low risk returns because that would mean that the returns are closer to being pure alpha. So even though you take on 1 times the risk of the market, you actually outperform the market by about 40%. You have 4 alpha, which is very good. Market would have done 10%, you would have done 14. That's 4% better, about 40% better, which is very good. And now we have a concentrated winner. So the concentrated winner actually has less beta than the overall market. It's about 0.9. Some stocks are less risky than the overall market. Your beta sensitivity depends on, say, if the market goes up 1%. If you go up, in this instance, you would go up 0.9% for every 1% goes up, meaning you're less risky than the overall market. But in this case, even though you're less risky than the overall market, you got about a 16% return, whereas the market would have only given you about a 9.4% return, which means you're beating the market by a large margin. You have a 6.6% alpha, or you're beating the market 60%, 66% better. But it's not a 66% return. Keep that in mind. You're just doing 66% better than what the market is, which is plus 6.6% alpha, which is very good. Plus 6.6% alpha. There's certain strategies used by very elite professional financial institutions that target these strategies. If you can get even a 5 to a 6% alpha, assuming very low risk, that's what a lot of quant firms also target. They don't want these huge returns. They're not looking at, oh, we want 40, 50% plus alpha in a year. No, they say, hey, we're happy with 5, 6, closer to that 10, 20, that Goldilocks zone. 10 to 20, you're a legendary fund. Typically anything more than that, you're mythical. But even like 6%, it's respectable for any real quant firm, because this is typically a lower risk strategy. Of course, a concentrated winner, a lot of the time that is luck. You're assuming you're buying maybe 1 stock or just a handful of stocks that happen to outperform for the amount of risk they take on. A good example is like FANG companies. If you can get into FANG companies before they were big, which was Facebook, Amazon, Netflix, Nvidia, Google, like those are the FANG ones. Those are some examples of concentrated winners. But of course, this is assuming you have a less than market risky, less than market risk stocks here, whereas the FANG would have actually been higher than market risk on average, but the returns would have been much more to compensate it. They might have taken on, say, 1.5 times market risk, but you're getting more than 15%. So these are the things you guys have to keep in mind. You have to look at your three variables: your risk, which is over here, your expected return, and then your market risk. Your market risk is a yardstick. It's what you have to measure your risk against, because you can get really high returns, but if you don't know what your risk is compared to the market, you're kind of in the dark. Because what if you're up here and you're like, well, I don't know, I have a, say, 2 beta, I did double the market, do I have any alpha? But then you have a 2 beta and you look at it, like, even though you got 16%, you're not beating the market by 6%. You don't have 6% alpha like this person does over here, because their beta is 0.9, but your beta is 2. So they're getting more about more returns than you are for the amount of risk that you're taking on, even though you guys have the same return. But because you're taking on double the risk and they're taking on less than half the risk you're taking on, they're outperforming you. And this is a good way of visualizing performance in the market, and how you should evaluate your portfolio and your trading strategy is by using something like this. This is not customizable, unfortunately. I just made this for demonstration purposes, but I'll have this linked hopefully in the description. I'll see what I can do so you guys can get access to it. And if you can't, message me in Discord. I'll pass it over. But yeah, hopefully you guys enjoyed.